Welcome to Module 4 of Global Finance and Electronic Banking. So this is entitled The Cost of Capital. In this module, you will learn to compute the cost of capital of a multinational corporation. You will also determine the input for capital budgeting and capital structure in a multinational corporation. So the outcome of this module is to compute the cost of capital of a multinational corporation, and these are the learning objectives. Determine the input for multinational capital budgeting and evaluate the factors to consider in multinational capital structure. So let's explore first. What is cost of capital? Cost of capital is the required return necessary to make a capital budgeting project, such as building a new factory, um, worthwhile. When analysts and investors discuss the cost of capital, they typically mean the weighted average of a firm's cost of debt and cost of equity blended together. The cost of capital metric is used by companies internally to judge whether a capital project is worth the expenditure of resources, and by investors who use it to determine whether an investment is worth the risk compared to the return. The cost of capital depends on the mode of financing used. It refers to the cost of equity if the business is financed solely through equity, or to the cost of debt if it is managed or if it is financed solely through debt. Many companies use a combination of debt and equity to finance their businesses, and for such companies, the overall cost of capital is derived from the weighted average cost of all capital sources, widely known as the weighted average cost of capital, or WACC. So let's understand more this cost of capital. So cost of capital represents a hurdle rate that a company must overcome before it can generate value, and it is used extensively in the capital budgeting processes to determine whether a company should proceed with the project. The cost of capital concept is also widely used in economics and accounting. Another way to describe the cost of capital is the opportunity cost of making an investment in a business, and wise company management will only invest in initiatives and projects that will provide returns that exceed the cost of their capital. So, cost of capital, from the perspective of an investor, is the return expected by whoever is providing the capital for a business. In other words, it is an assessment of the risk of a company's equity. In doing this, an investor may look at the volatility of a company's financial results to determine whether a certain stock is too risky or would make a good investment. So why is cost of capital important? The cost of capital is important for several reasons. Cost of capital is an essential economic and accounting tool that can maximize potential investment for businesses. And here are some of the detailed reasons why cost of capital is important. First is it helps investors assess their options. It assists capital budgeting decisions, since businesses must decide if a project is worthwhile before starting. It is essential for businesses to design the ideal capital structure of the firm, and it can also be used to evaluate the performance of certain projects as compared to the cost of capital. So how will we compute cost of capital? To calculate the weighted average cost of capital, you must first calculate the cost of debt and the cost of equity. The cost of debt and the cost of equity can be represented by these formulas. So first, find the cost of debt. This is the formula. Cost of debt equals total debt divided by interest expense times 1 minus t. Next is find the cost of equity. The cost of equity refers to the return a company requires to determine if the capital return requirements are met in an investment. A business cost of equity also represents the amount the market demands in exchange for owning the asset and therefore holding the risk of ownership. RF refers to the risk-free rate of return and RM refers to the market rate of return. And beta allows for sensitivity to movements in the market. So cost of equity can only be approximated with the capital asset model showed. So CAPM, or the cost of equity, is equal to RF, or the risk-free rate of return, plus beta times RM, or the market rate of return, minus risk-free of risk-free rate of return. Next is find the weighted average cost of capital. So a business cost of capital is based on the weighted average of the cost of debt and cost of equity. And this is the formula. So you can see that. In this formula, E refers to the market value of the firm's equity. D refers to the market value of the firm's debt. V is the sum of E and D. RE refers to the cost of equity. RD refers to the cost of debt. TC refers to the income tax rate. So if the after-tax debt is already considered, then you may leave off the latter part of the formula, which is 1 minus TC. So for instance, consider a business with a capital structure that consists of 60% equity and 40% debt. Their cost of equity is 10% and the after-tax cost is 8%. The weighted average cost of the capital would be 13.7%. So you may look it up on the module provided to you. Now let's discuss capital budgeting. So what is capital budgeting? Capital budgeting is the process a business undertakes to evaluate potential major projects or investments. Construction of a new plant or a big investment in an outside venture are examples of projects that would require capital budgeting before they are approved or rejected. As part of capital budgeting, a company might assess a prospective project's lifetime cash inflows and outflows to determine whether the potential returns that would be generated meet a sufficient target benchmark. The capital budgeting process is also known as investment appraisal. Let's understand more about this capital budgeting. So ideally, businesses would pursue any and all projects and opportunities that enhance shareholder value and profit. However, because the amount of capital or money any business has available for new projects is limited, management uses capital budgeting techniques to determine which projects will yield the best returns over an applicable period. So although there are numerous capital budgeting methods, below are a few that companies can use to determine which projects to pursue. First is the discounted cash flow analysis. So this analysis looks at the initial cash outflow needed to fund a project, the mix of cash inflows in the form of revenue, and the other future outflows in the form of maintenance and other costs. Next is the present value. So these cash flows, except for the initial outflow, are discounted back to the present date. So the resulting number from the DCF, or the discounted cash flow analysis, is the net present value, or NPV. The cash flows are discounted since present value states that an amount of money today is worth more than the same amount in the future. So with any project decision, there is an opportunity cost, meaning the return that is forgone as a result of pursuing the project, and in other words, the cash inflows or revenue from the project needs to be enough to account for the costs, both initial and ongoing, but also needs to exceed any opportunity costs. With present value, the future cash flows are discounted by the risk-free rate, such as the rate on U.S. Treasury bond, which is guaranteed by the U.S. government. The future cash flows are discounted by the risk-free rate or discount rate because the projects need to at least earn that amount, otherwise it wouldn't be worth pursuing. So the cost of capital, a company might borrow money to finance a project and as a result, must at least earn enough revenue to cover the cost of financing it or the cost of capital. Publicly traded companies might use a combination of debt, such as bonds or a bank credit facility, and equity or stock shares. The cost of capital is usually a weighted average of both equity and debt. The goal is to calculate the hurdle rate or the minimum amount that the project needs to earn from its cash inflows to cover the costs. A rate of return above the hurdle rate creates value of the company, while a project that has a return that's less than the hurdle rate would not be chosen. Project managers can use the DCF model to help choose which project is more profitable or worth pursuing. Projects with the highest NPV or the net present value should rank over others unless one or more are mutually exclusive. However, project managers must also consider any risks of pursuing the project. Let's discuss payback analysis. Payback analysis is the simplest form of capital budgeting analysis, but it's also the least accurate. It's still widely used because it's quick and can give a manager's back of the envelope understanding of the real value of a proposed project. Payback analysis calculates how long will it take to recoup the costs of an investment. So the payback period is identified by dividing the initial investment in the property by the average yearly cash inflow that the project will generate. For example, if it costs $400,000 for the initial cash outlay and the project generates 100,000 per year in return, it will take 4 years to recoup the investment. So this payback analysis is usually used when companies have only a limited amount of funds to invest in a project and therefore need to know how quickly they can get back their investment. The project with the shortest payback period should likely be chosen. However, there are some limitations to the payback method since it doesn't account for the opportunity costs or the rate of return that could be earned had they not chosen to pursue the project. Also, payback analysis doesn't typically include any cash flows near the end of the project's life. For example, if a project being considered in full involved buying equipment, the cash flows or revenue generated from the factory's equipment would be considered, but not the equipment's salvage value at the end of the project. So the salvage value is the value of the equipment at the end of its useful life. As a result, payback analysis is not considered a true measure of how profitable a project is, but instead provides a rough estimate of how quickly an initial investment can be recouped. Next is the throughput analysis. So throughput analysis is the most complicated form of capital budgeting analysis, but also the most accurate in helping managers decide which projects to pursue. Under this method, the entire company is considered as a single profit-generating system. Throughput is measured as an amount of material passing through that system. The analysis assumes that nearly all costs are operating expenses, that a company needs to maximize the throughput of the entire system to pay for expenses, and that the way to maximize profits is to maximize the throughput passing through a bottleneck operation. A bottleneck is the resource in the system that requires the longest time in operations. This means that managers should always place a higher priority on capital budgeting projects that will increase throughput. So key takeaways. Cost of capital represents the return of the company needs in order to take on a capital project, such as purchasing new equipment or constructing a new building. Cost of capital typically encompasses the cost of both equity and debt weighted according to the company's preferred or existing capital structure, known as the weighted average cost of capital, and the company's investment decisions for new projects should always generate a return that exceeds the firm's cost of the capital used to finance the project. Otherwise, the project will not generate a return for investors. Capital budgeting is used by companies to evaluate more projects and investments such as new plants or equipment. The process involves analyzing a project's cash inflows and outflows to determine whether the expected return meets set benchmark. And the major methods of capital budgeting include discounted cash flow, payback, and throughput analysis. Now, let's discuss the capital structure. So, what is capital structure? It is the particular combination of debt and equity used by a company to finance its overall operations and growth. So the debt comes in the form of bond issues or loans, while equity may come in the form of common stock, preferred stock, or retained earnings. Short-term debt is also considered to be part of the capital structure. So let's understand first this capital structure. So both debt and equity can be found on the balance sheet. Company assets also listed on the balance sheet are purchased with this debt and equity. So capital structure can be a mixture of a company's long-term debt, short-term debt, common stock, and preferred stock. A company's proportion of short-term debt versus long-term debt is considered when analyzing its capital structure. When analysts refer to capital structure, they are most likely referring to a firm's debt-to-equity ratio, which provides insight into how risky a company's borrowing practices are. Usually, a company that is heavily financed by debt has a more aggressive capital structure and therefore poses greater risk to investors. So the risk, however, may be the primary source of the firm's growth. Debt is one of the two main ways a company can raise money in the capital markets. Companies benefit from debt because of its tax advantages. Interest payments made as a result of borrowing funds may be tax deductible. Debt also allows a company or business to retain ownership, unlike equity. So additionally, in times of low interest rate, debt is abundant and easy to access. Equity allows outside investors to take partial ownership in the company. Equity is more expensive than debt, especially when interest rates are low. However, unlike debt, equity does not need to be paid back. This is a benefit of the company in the case of declining earnings. On the other hand, equity represents a claim by the owner on the future earnings of the company. So, how will we measure the capital structure? So, companies that use more debt than equity to finance their assets and fund operating activities have a high leverage ratio and an aggressive capital structure. A company that pays for assets with more equity than debt has a low leverage ratio and a conservative capital structure. That said, a high leverage ratio and an aggressive capital structure can also lead to higher growth rates, whereas a conservative capital structure can lead to lower growth rates. Analysts use the debt to equity ratio to compare capital structure. It is calculated by dividing total liabilities by total equity. So savvy companies have learned that incorporate both equity they have learned to incorporate both equity and debt into their company corporate strategies. So at the times, however, companies may rely too heavily on external funding and debt in particular. Investors can monitor a firm's capital structure by tracking the debt to equity ratio and comparing it against the company's industry peers. So how will we compute capital structure? So for example, let's consider two different examples. So for example, a company A, for our purposes, has $150,000 in assets and 50,000 in liabilities. So this means that the company's equity is 100,000 kasi 150,000 assets minus 50,000 liabilities. So let's go back to the equation. Assets equals liabilities plus equity. So equity is $100,000. This means that for every 50 cents of debt, the company makes $1 of equity. This then would be an example of a low leverage or even low risk equity capital structured company. Now, take its crosstown rival, Company B. So Company B has 120,000 in assets, 100,000 in debt, and therefore 20,000 in equity. So 120 minus 100 is 20. This means not only that the company needs to increase its returns to be able to finance its debt eventually, but the company also will be reviewed as a greater risk for future lenders. Kasi masyadong malaki yung debt niya. So, our real life, this is considered highly leveraged pala kasi for every $5 of debt, the company has $1 in equity. So, a real-life example of a vendor financing capital structure was when Sam Walton's Walmart now took off. Walton was able to often sell Tide and other Procter& and Gamble products before having to pay P&G. Yan, so it used P&G's money to grow. How will we calculate capital structure? So since the capital structure is the amount of debt or equity or both employed by a firm to fund its operation and finance its assets, capital structure is typically expressed as a debt-to-equity ratio. So to calculate the debt-to-equity ratio, the formula is relatively straightforward. So the company's total liabilities are divided by its shareholders' equity. So kanina, sa example natin, si Company A, meron siyang 150,000 assets and 50,000 in liabilities. So, paano mo malalaman yung equity niya? Ibabawas mo ngayon yung liability sa asset. So, 150 minus 50. And let's go back here. Yan. So, ibinawas natin yung 150 minus 50, kaya naging 100,000. So, dividing company's A's total liabilities of 50,000 by its shareholders of $100,000. So, 50,000 divided by 100,000, it has a 0.5 debt to equity ratio. Meaning, for every 50 cents of debt, the company has $1 of equity and is therefore low leverage. So, debt to equity, ibig sabihin, liabilities divided by the equity. For our example, Company B. So, it has $120,000 in assets but $100,000 in debt. This means that the equity is $20,000 but its liabilities are $100,000. So, pag debt to equity ratio, $100,000 divided by $20,000, it's 5. This means that for every $5 of debt, Company B hold $1 in equity. So, it is considered as highly leveraged. Yan. So what are the key takeaways? Capital structure is how a company funds its overall operations and growth. Debt consists of borrowed money that is due back to the lender, commonly with interest expense. And equity consists of ownership rights in the company without the need to pay back any investments. And debt to equity ratio is useful in determining the riskiness of a company's borrowing practices. So that's all for this module. And feel free to answer in advance the activities at the end of the module. So you already have finished module 4 entitled The Cost of Capital. So I hope you enjoyed this module as you have actively participated in the different activities. And now you are down to your next and last module for this course. Prepare yourself as you will be discussing the foreign direct investment and craft a strategic plan for FDI. So enjoy reading and viewing. I've also added additional readings and references in the module which you can check. Ayan, thank you.